everyone! Welcome back to Canada Accounting Insights. Today, we're diving into one of those topics that always shows up when you least expect it. Events after the reporting period, or what we often call subsequent events. You might be wondering, what exactly counts as a subsequent event? When should I adjust the financial statements, and when is disclosure enough? Don't worry. By the end of this video, you'll have a crystal clear understanding of the difference between adjusting and non-adjusting events, the going concern impact, and of course, the key differences between IFRS and ASPE. Before we jump in, don't forget to like this video and subscribe to the channel. It really helps support more content for CPA candidates like you. All right, let's get started. Let's start with the definition. Under IFRS, specifically IAS 10, events after the reporting period. These are favorable or unfavorable events that occur between the end of the reporting period and the date when the financial statements are authorized for issue. So for most companies, this means between year-end and the date the board of directors approves the financial statements. That's our subsequent events period. Now, why does this matter? Because we want the financial statements to reflect all information that gives a fair picture of what was really happening at year-end, even if we learned it a few weeks later. If the event is not material, you can stop right there. But if it is material, then you need to determine which type it is, adjusting or non-adjusting. And that's where the accounting treatment changes. IAS 10 divides subsequent events into two main categories, adjusting events and non-adjusting events. The key difference comes down to timing and relevance. Adjusting events provide evidence of conditions that already existed at the end of the reporting period. Non-adjusting events, on the other hand, are conditions that arose after the reporting period ended. Everything that happens before the financial statements are authorized for issue falls into one of these two groups, and it's our job to assess which one applies. Let's break down adjusting events first. These are events that give us new information about something that already existed at year-end. And because that information changes the way we measure assets or liabilities, we must adjust the financial statements before they're issued. Here are some common examples you should know. Court cases. Suppose a lawsuit existed at year-end and gets settled shortly after. That confirms the company had a present obligation, so a liability must be recorded and the expense recognized. Impairments. If we learn after year-end that an asset was already impaired as of December 31st, we must adjust its carrying value and recognize the impairment loss. Bankrupt customers. If a major customer goes bankrupt right after year-end, that's evidence their receivable was already impaired. We'd adjust our allowance and record additional bad debt expense. Inventory write-downs. If inventory is sold below cost soon after year-end, that sale gives evidence the net realizable value was lower than carrying value. The write-down should be recorded as of the reporting date. Fraud or errors discovered. If you uncover fraud or material errors after year-end that show the financials were incorrect, you adjust them accordingly. Let's bring this to life with an example. Imagine Toy Tum Corp., a toy manufacturer with a fiscal year end of December 31st, year 1. On January 15th, year 2, before the financials are approved, Zoo learns that JJ Toys, one of its biggest customers, has declared bankruptcy. At year-end, Toy Tum had an accounts receivable balance from JJ Toys that now won't be fully collectible. They'll only recover about 75%. Because this new information relates to receivables that already existed on December 31st, it's an adjusting event. So Toy Tum Corp. Must reduce its accounts receivable balance and record a bad debt expense in the year 1 financial statements. Now let's talk about non-adjusting events. These are events that happen after the reporting period and do not relate to conditions that existed at year-end. Even though they aren't recorded in the financial statements, they can still be material, meaning users should know about them. That's why they are disclosed in the notes instead. For each material non-adjusting event, we must disclose the nature of the event and an estimate of its financial effect, or a statement that an estimate can't be made. Here are some classic examples straight from IAS 10. Dividends declared after year-end, a major business combination or restructuring announcement, destruction of a major production plant, large share transactions, significant changes in tax rates, or major litigation that arises only after year-end. Here's a simple illustration. Nanocorp has a March 31st year end. In April, before the financials are authorized, a flood destroys its main manufacturing facility, and the damage is uninsured. Now, does this affect the March 31st financial statements? No, because the flood occurred after year end and doesn't tell us anything about conditions that existed at that date. So Nanocorp doesn't adjust its March 31st numbers. Instead, it discloses the event in the notes, quantifies the loss, and possibly comments on the expected impact on next year's profits. That's a perfect non-adjusting event example. Now here's an important twist: the going concern assumption. Sometimes a subsequent event reveals that the company can no longer continue operating as a going concern. For example, management might decide to liquidate, or maybe the company loses a major contract and no longer has financing to survive. If that situation becomes clear after year-end, but before authorization, the company must stop using the going concern basis of accounting. Instead, it restates its financial statements at liquidation values, which are usually lower than fair value because the assets must be sold quickly. So in essence, even though this event happens after year-end, it's so significant that it changes the entire basis of preparation. Regardless of whether the event is adjusting or non-adjusting, IAS 10 also requires a few specific disclosures. The date when the financial statements were authorized for issue, the individuals or bodies who authorized them, whether anyone has the power to amend the financial statements after they've been issued. This helps users know exactly which events were considered and which were not when the statements were finalized. Let's move on to how this differs under ASPE 3820. The big difference between IFRS and ASPE is the end date of the subsequent event period. Under IFRS, it ends on the authorization date, when the board approves the financial statements for release. Under ASPE, it ends on the completion date, when the financial statements are finished being prepared. In most cases, these two dates are the same. But in smaller entities where the board meets infrequently, there can be a gap, meaning the subsequent event window is longer under IFRS than under ASPE. Let's look at an example. Tribus Corp follows ASPE and has a December 31st year end. Here's what happens. On January 31st, a lawsuit is settled for $250,000, even though the company had only recorded a $150,000 contingent loss at year end. On February 7th, a fire destroys inventory costing $78,000, with a retail value of $160,000. The financial statements were completed on February 20th. Here's the analysis. The lawsuit is an adjusting event because it relates to a condition that existed on December 31st. Tribus updates the contingent loss to the final settlement amount. The fire, however, is a non-adjusting event. It doesn't relate to year-end conditions. So Tribus only discloses the loss in the notes without recording an entry. All right, let's recap everything we learned today. Subsequent events are events occurring after year-end but before authorization of the financial statements. They can be adjusting or non-adjusting. Adjusting events give evidence of conditions that existed at year-end, so we record them. Non-adjusting events arise after year-end, so we disclose them in the notes. If a subsequent event affects going concern, we restate the financials at liquidation values. And under ASPE, the cutoff date for subsequent events is the completion date, not the authorization date. And that's a wrap. If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss future breakdowns of tricky IFRS and ASPE topics. Thanks for watching Canada Accounting Insights, where we turn accounting theory into real-world clarity. See you in the next video.